Well, hello. This is Danielle DiMartino Booth with your next installment of Down the Middle with DiMartino Booth. I'm delighted today to have Peter Atwater join me outside of being a great Twitter buddy of mine, which who isn't? He runs Financial Insights, a consulting firm, and he teaches economics at William and Mary College in Williamsburg. And before we get to that, because I'm so fascinated about the world of economics and academia, because I was kind of thrown into it working at the Federal Reserve, not knowing I was going to be thrown into it. But before we get there, I always like to go back to people's childhoods. And I'm going to start a little bit later in yours, because you somehow ended up growing up in New Jersey and graduating from high school in Paris, France. And I'm not quite sure how that works. So why don't we start there?
Sure. It works pretty easy when your dad gets transferred as you're finishing your junior year in high school. And so, a little bit of gnashing of teeth. Do I stay? Do I go? We were looking at different options. And I'm really glad we went. It's pretty cool, going to high school in Paris, particularly, I grew up in a fairly rural part of New Jersey. And so to go from that, where everything was 20 minutes, a half hour away by car, to hopping on the metro. I mean, we would all meet Friday nights at the top of the metro stop by the Arc de Triomphe, and then you'd go do whatever. And it was a blast.
Oh my gosh. I mean, to me, it would be like being on a field trip every day.
Yeah, and your sports teams, where you're playing local high schools in New Jersey, they would be playing the American school in Milan, the American school in London, the American school in The Hague. And so you'd go all over Europe just sort of as if it were normal for everybody.
And was that typical American football you were playing?
I was not playing American football, no.
What was the sport?
So, a little bit of volleyball, but mostly just going along. It was.
I would have done the same thing. They could have told me it was bowling, and I've been like, if we're going to The Hague, I'm on. So that's pretty amazing. So obviously you picked up French.
I did.
Is that something?
I had to.
Well, yeah.
It's a fairly plebeian vocabulary that I have. It's, shopping and buying food and, just getting around. But yeah, I can get myself out of trouble if I have to.
And probably a younger drinking age. I'm not sure why I'm thinking of that, but you'd have to think that Europeans would be a little bit more relaxed than Americans.
There was no drinking age, as I recall. So yeah, it was quite interesting going from, sneaking six packs to just, have a good time at the cafe.
So did you think about staying in Europe for your college studies? What brought you back to the United States?
So I had always planned to come back to the U.S. for college. And, a lot of people said, why didn't you do a junior year abroad? And, honestly, being there for summers, being there for different breaks, I didn't see the need to do that.
Sure.
I did hope for at some point to have a overseas assignment with work, but that never happened, and that's okay.
So what I really want to know about William and Mary is the whole Jon Stewart thing. However, I'm also kind of a history buff. And in one of my recent weeklies, I studied the history and the founding of Harvard University. So in studying up on you, I found out that we're talking about a combination of King William III, Queen Mary II. I'm watching too much Netflix. Trust me when it comes to the crown these days. So this is all so fascinating to me. But I think I've got it written down right. A letters patent. So I might be putting you on the spot, but what the heck is a letters patent, and how does it, coming from England, end up founding the second oldest school in America? 1693. Amazing.
1693, yeah. So George Wythe and others convinced the Crown to set up a college here in the U.S. And this was a time that the Crown was being incredibly charitable. If you look at a lot of the hospitals in London, for example, they sort of date from the same era of benevolence.
Huh.
And so there was a sense, let's educate these folks afar. And yeah, William and Mary, second oldest college in the country. And it's wild place because it sits at the end of colonial Williamsburg. So the WREN building sits as one bookend. And on one side, you have all of these folks dressed in 18th century garb, all doing recreation. And on the other side of the building, there's this huge field where on any given day, you'll see people throwing a frisbee, playing catch, basking in the sun.
Right.
It's really kind of fun.
Well, okay, so this is a question you might not have the answer to, but it's just a burning in the back of my head. Did Williamsburg precede the college, or was Williamsburg named after the college?
That's a great question.
I know, isn't it?
Yeah.
All right, so you're going to have to tweet. You're going to have to tweet out the answer.
And I have a few folks that I know who will know that answer. So
yeah,
I will let you know. Because
I would think, when you think of New York and all of these things that were new were just new in the new world. In any event, okay, let's get to what I really want to know. John Stewart, you were his RA?
Yeah, freshman RA. Yeah, first Yates, first South. John was a soccer player. He actually played on the varsity soccer team. And, I think all of us are amazed. He was biting and sarcastic even then. And so I just give him huge props for finding a way to monetize it as well as he did.
Living the dream, yeah.
Very smart guy. Very smart.
So you studied economics in college. Did you know you were going that route?
No, I started off as a physics major. My dad's an engineer. And so it was very clear that whatever I majored in needed to result in a job. And I took a freshman econ class having to fulfill various requirements and had a great professor. And I can remember going home, raising the topic with my parents over an awkward Christmas dinner about the fact that I was going to switch and become an econ major. And sort of, what are you going to do with that being the response? And fortunately, did okay.
So I get the econ part, but you didn't go off into economics after that. Was what drew you to what we think of as a conventional bank, but you'd be hard pressed to find anybody right now who could envision JP Morgan as being a conventional bank, because we think of it as the bank that is now bigger than Goldman Sachs, the big investment bank. But what drew you to JP Morgan, and why not economics to start off, other than the fact that economists don't make very much?
So I've never thought of myself as an academic. I was more interested in sort of the applied aspects of economics, money and banking, and international finance. Mm-hmm. And going to the American school, there were lots of children of parents who worked at different banks in Paris. And so names like Morgan Guarantee, First Bank of Boston, there were lots of names, and thinking at some point, if I wanted to get back to Europe working for a bank, I was looking for a bank that had international experience, and that's what really drew me to Morgan Guarantee.
Right. So you started in '83, and I think of, because I'm a big student of the subprime crisis, I always think of the early '80s as kind of the advent of credit in U.S. households. We were kind of headed towards the yuppie era, but this is really when the baby boomer generation started to embrace credit. So you had a front row with popcorn view to this evolution of the U.S. consumer. Talk to me about it.
Yeah, so I consider myself one of the luckiest people in terms of timing, right place at the right time.
Yeah.
To your point, this is the beginning of the democratization of consumer credit. And so you have banks interested in credit cards, car loans, home equity loans, lots of mortgage credit. And I started JP Morgan working in a group called the Asset Finance Group, which was working with folks like Sears, trying to figure out how do you help them to raise credit backed by their credit card receivables. You're doing the same thing with Ford, doing the same thing with GM. And
wait, is that like factoring?
Well, in a traditional sense, yes, but not for a company like Ford or GM or it was more, how do you find a cheap way for them to raise capital against their loans?
Okay.
And so we're doing all of this work trying to understand the portfolio characteristics, the payment rates, default rates, and essentially setting in motion the asset-backed securities business, securitization. And what was fascinating, it was frustrating initially because we're doing all this work and then you'd see First Boston land a deal for GM and you're like, we can do the same thing. We just didn't have the underwriting powers.
Right.
And at that point, there was then this groundswell among the banks, particularly folks like Citi, who were like, look, we have all these assets. Why should we have to hire First Boston, Solomon, to underwrite assets that are on our balance sheet? And
because those were some big, those were where the fees were.
Those were where the fees were. And so it was a big push with the Fed to let the banks get into the underwriting business, but in a way that the Fed thought was safe. So first thing, commercial paper. Essentially, banks have been doing bankers' acceptances for, since the beginning of time. Commercial paper was a natural add-on. And then they said, let's do asset-backed securities. And so within moments, we pivoted from put it on our balance sheet to package it and sell it off.
So this would have been around the same time as Ranieri coming up. I think, now I'm going to put my own foot in my mouth, but I think this is also when kind of when mortgages were changing the way that they were packaged.
Oh, yeah. I mean, Louis, Larry Fink, you don't think of him in that position now, but his roots were in First Boston's asset-backed business building its mortgage franchise.
Wow, the things we don't know. So I know that you study behavior a lot, but I want to stay with this kind of era, if you will, for a little while. Did you get to see how credit or the access to credit changed consumers' behavior kind of as a factor of time?
Absolutely. You saw particularly in the auto space where it went from saving up for a car, having a down payment for a car, to financing all of the car. So it transformed it from a capital intensive, what's the price of the car issue, to what's the monthly payment on the car. And so we essentially changed the consumer's mindset in the same way the mortgage industry did for housing. Nobody really cares that much about the cost of the house. It's what's the monthly payment on the house.
I think I was way too influenced by my mother growing up with her grandparents who were kind of scarred by the first depression early on in the 1900s and then the Great Depression, because I still look at price. I've never bought anything on credit, and I've only had a mortgage for a few years and I couldn't sleep while I did. But on the other hand, I worked at the Federal Reserve for a few years, and that'll give you all kinds of. But speaking of the Federal Reserve, so you were also You were there at JP Morgan for 13 years. You were there when Alan Greenspan got his start in the business. So what, I'm curious.
You know who was the director of JP Morgan?
I did not.
Yeah, when I first joined, he was on the board.
How cozy. Well, I've always wondered where his obsession with the stock market came from. Because when he was chairman of the Federal Reserve, every morning when he got to his office, he needed his overnight what happened in the equities world on his desk, his briefing. And in his biography, it goes into the fact that completely shaped his tenure at the Fed. And he actually takes away from himself that this happened. He considers it to be one of his faults. But anyways, we could go off on that tangent all day long. So you left. Well, first of all, there's a story there, and I actually want to ask you about not just the moment, and you can tell the story, but also how moments change us, and because we all have one. But tell us first about your moment.
In which
I'm
sense?
sorry, when you decided to make a complete, turn in your life and say, okay, this is it. It's it's time to make a change.
So I'm turning 45, and I'm getting ready to blow out the candles on the cake. True story. And my son looks at me, and at that point he was 8, and he looks at me and he says, "Dad, you're halfway to 90." And you talk about one of those, sort of gut-wrenching punches. It's like, yeah, I am.
Yeah.
And I sort of concluded at that point that I didn't want to keep doing what I was doing. Didn't know entirely what I wanted to do next, but it was a moment of, I need to stop doing what I'm doing. And I give my wife enormous credit for insisting that if I made the decision that I was going to make to stop, that I not commit to anything for a year. She said, "I know you. You're going to stop, and somebody's going to call you in 2 weeks and say, I've got this great opportunity over here. Why don't you come do it?" And you're going to say yes. And so I had to just not do something for a year, which for a type A like me was really hard.
I can only imagine.
And amidst that, one of the things that I was quite passionate about, still am, was financial literacy. And my wife found this article about this website that was focused on financial literacy called Minionville, founded by now a very dear friend of mine, Todd Harrison. And so I'm looking online, and this is 2005, 2006, and I'm watching people writing about consumer credit, and I'm like, no. That's not exactly how this works. And so initially I approached Todd to say, I'm happy to contribute. Not sure what I'm going to do next, but can I do it anonymously? And so we used the pseudonym Minion Peter for probably 18 months, 2 years. But the more I started to write, the more I got questions from people about, well, what else? What did I think of this? What did I think of that? And going into 2007, I found myself advising a small group of hedge funds, some money managers, helping them to prepare for what would become the financial crisis. Mm-hmm. That it was obvious, having spent my career in securitization, having been a bank treasurer, having worked with the rating agencies. You couldn't have picked a better crisis for me.
Sure. But you presumably saw all of this coming.
Yeah, tragically so. I mean, anyone looking in any direction. I mean, it wasn't just that the overconfidence was in one place, it was in every place.
Mm-hmm.
I mean, that the whole entourage was convinced that housing prices only went up.
Oh yeah, we evolved, so to speak, at the same time, because I was writing about the housing crisis when I was asked to join the Federal Reserve, and the running joke was that they hired me to shut me up because I was writing these awful things about people taking all this money out of their homes, and but I mean, it was surreal to join the Fed because when you walked in the door, you're like, okay, the gig is up, right? You guys are kidding, right? Everybody there believed everything that Greenspan and then Bernanke said, that home prices could only go up. And, we didn't know until years later that Alan Greenspan's dissertation, which was buried in a basement somewhere, was on housing bubbles. So he knew kind of what was, happening on his watch. Janet Yellen, famously was at the San Francisco Fed at the time and didn't see it coming either. But what was, in your view, because I get questions about this all the time, the Fed caused the housing crisis, the banks caused the housing crisis. Run us through all the players.
I think everyone was culpable.
Mm-hmm.
I mean, and that's the nature of saturating overconfidence, is that whether it's within a company like Boeing, in the days and weeks before those crashes, in an economy more broadly, everybody succumbs, and it's chemicals in our brain. It's the crowd effect of wanting to fit in with our peers. I mean, the factors are numerous, but we all were guilty. We took the loans we shouldn't have. They gave us the loans they shouldn't have given us. So you can tick every box.
Mm-hmm.
And your comment about trying to find the culpable individual, is sort of what steered me into the work that I do today, which is let's look at the behaviors horizontally. Let's look at what are people doing in common, because that common experience is going to tell us everything we need to know about how the crowd feels. And so I think the crowd was guilty, and it was guilty at the top, and it was equally guilty at the bottom of then being far too pessimistic. Everybody felt in 2009 that it was just going to get worse.
Mm-hmm.
Regulators, policymakers, individuals, homeowners, everybody in the lot. So to me, the guilt exists in both ends of the spectrum.
So I'm dying to get where we are today, but I can't. I have to wait. Go back to Minionville for a minute, just because I want to commiserate, or I want to enjoy it with you, or live vicariously. I mean, when I got away from compliance, it was like breathing oxygen for the first time. What were those 18 months when you were writing anonymously? I mean, I know what I felt. How did it feel?
I had never thought of myself at that point, as a blogger, writing something. And my mindset, Danielle, was how can I be helpful to people?
Mm-hmm.
I don't want people to be misled by all of the noise, and to be able to see in a way that was not, volatile. I wasn't trying to throw gas on a fire, but more trying to help folks to navigate what was clearly going to be a difficult time and not to get swept up in it.
Did we learn our lesson as households, as consumers, in the aftermath of that subprime crisis?
For a little while, yes. But we are an optimistic animal.
Mm-hmm.
And we easily like the next bright, shiny thing. And I think, in fairness to the consumer in this cycle, there was a lot of seduction being thrown out by policymakers in the form of free money. and so I can't blame consumers in this case.
Mm-hmm.
What stuns me, is that the adults in the room, corporate treasurers today, are the home flippers of 2005. They swallowed the bait and have over-levered what I call the last balance sheet. The last balance sheet available was the big corporation. Mm-hmm. And we have trashed them.
So let's talk about this, because this is, I've been looking at the Powell era, and we don't realize it. And I was looking at the continuum, because I was saying just yesterday, I was writing about 2020 and it being the largest growth in global debt ever. And I looked back and I got the data, and it's not. It's not. 2007 was the biggest year for global debt growth. And that was, of course, when our mortgage market was the biggest, still the biggest debt market in the world. And then, speaking of Powell, 2017. Now, 2017, you had global quantitative easing. The run rate was over $2 trillion that year. And then he took office, February the 4th, 2018. And this is when Europe was tapering. This is when the United States was not engaged in quantitative easing. And this is when a very sober and determined Jay Powell was going to normalize interest rates and shrink that balance sheet, by golly. And it was as if somebody flipped a switch on him. And so I've been, Volmageddon, the volatility incident in February. I mean, his first day in office, the Dow Jones was down more than 1,000 points. And he said nothing. But then you got towards Halloween, speaking of balance sheets, and Halloween, we had the debt of General Electric downgraded. And then issuance froze, and Powell has since evolved, shall we say, speaking of swinging from one end of the spectrum to another. But talk to me about the adults in the room and those CFOs, and what's happened in the space of the last decade in corporate America.
So I think that they reach a point where they've grown in size, that the game of mergers becomes more challenging. And remember that this has been a culture of buy, eviscerate, buy, eviscerate, buy, eviscerate. So growth through destruction of the operating costs of what it was that you acquired.
Peter, they call that synergy. They use a much more polite term.
Yes. Or as they said at Exxon, recently, culling, which I thought was just horrific. But I think that where you ended up was the only way to grow earnings per share in order to meet rising expectations of the analyst community was financial engineering. Mm-hmm. And with free money, you could financially engineer whatever EPS you wanted for the next 6 quarters. And we did. Corporate America, this buyback game, whatever it took mm-hmm. to achieve these results. And I don't think folks really appreciate that one of the tenets of this post-banking crisis era, and you're seeing it even more in 2020, was size gave you access. That the simplicity of the mindset today is, if you are big, you are rich, you get credit, you get access to the equity market, you get whatever you want. And we can drill down on the role that the rating agencies play in this, but I think that the environment has so advantaged the big and the mighty that they have become lazy and really have no sense of what it would mean to manage a true economic cycle without the Fed, without fiscal stimulus, without any of the training wheels that have kept the bicycle upright in the past decade.
Yeah, I mean, just to take but one example, I'm not picking on them. I mean, I like a movie as much as the next guy. But, when I was looking at AMC's financials, they've been running up debt at a faster pace than they've had operating income for 4 years now. So, I mean, that's one of my pet peeves. And boy, do I should really stay off Twitter at night. But anyways, one of my pet peeves is that they call it the coronavirus recession. It's not, because this has been coming. This has been building for a long time. But my question to you is, so in the subprime crisis, you kind of saw what was coming. And you can also see what was coming today. We've displaced the household with the U.S. corporate. And it's not on bank balance sheets. It's all over the capital markets. But can you see what's coming today?
Yeah, you can. The manias are obvious around us. You can, whether it's Bitcoin mania, SPAC mania, EV mania, ESG mania. There's this collective enthusiasm. All the space travel stuff. We have this classic futuristic mindset that, whether it's communication, transportation, technology, the payment space, to me, may be the most egregious. But yeah, you can see where the excesses are. They're in plain sight. And they're where everybody has made the most money, believing that the most money is yet to come.
So, as somebody who is still suffering from post-traumatic stress syndrome from working inside the Fed for 9 years, I'm going to jump to my very last question right now, which is totally against the rules. But here we are. Another Peter friend of mine, Peter Bookvar, has always maintained that what we're in right now is a confidence bubble. And as long as people have confidence in the power of the central banks, everything's going to be fine. So what shakes this confidence? Because, I mean, when you consider what was done on March the 23rd, which, by the way, Jay Powell was prepared for after General Electric got downgraded. I mean, that was a plan that the Fed had in place in the event of a black swan. But I was listening to Jim Chanos get interviewed about being short Tesla for the last 5 years. I don't even know how he's still standing, even though he's probably the savviest, short man on the street. But what can shake this confidence in the Fed?
So let's talk about confidence in the Fed.
Sure.
So in the work that I do, I try to step back and say, okay, what would be a useful barometer, an objective measuring stick for confidence in X? So if I'm looking at a company, I'm going to look at its stock price, because that to me is a great barometer of confidence in management, confidence in the product, confidence in whatever it is. So I can look every day, and people debate, does price rise with With confidence, is confidence per stock. I don't care. It's an equalizer.
Sure.
It's just a way to look and assess. So then I say, okay, for the Fed, what would be a good proxy for confidence in the Fed? So I step back and I say, so when did confidence in the Fed suck? When were people viewing the Fed as incompetent? Well, you go back to the late 70s, early 80s, right? Mm-hmm. And you say, okay, so what stands out? Well, to me, interest rates stand out. Interest rates were spiking. And so I step in and I say, okay, let's say interest rates are a measure of Fed confidence in inverse relationships. So you could say the price of bonds. And so I then say, okay, the low in confidence for the Fed was 1980. So now I'm looking at the 10-year. When did rates bottom? Well, first time they bottomed was what? 2014. Mm-hmm. I've got my dates right. And you'll notice something really interesting. What happened when rates started to rise just after that?
Well, okay, I'm going to let you tell me, but then I'm going to hit my head like I needed a V8. And now I'm going to take notes.
PIMCO, the world's biggest bond manager, imploded. And the king of bonds essentially is exited from the scene. Bill Gross leaves. So I step back and say, yeah, interest rates are a great proxy for confidence in the Fed, in fixed income money managers, in the credit community more broadly. So I look at this and say, confidence in the Fed will remain so long as interest rates are managed in this low bound. But when they start to move up, the system is inherently very, very fragile. It's going to be 1980 in reverse, because we are as overconfident today as we were underconfident 40 years ago.
Right.
They were inept now, they're omnipotent today. And omnipotence, to me, is always the end. And we believe, the system believes, central banks are omnipotent. And there is inherent fragility to that I don't think is being reflected in valuations of anything. And to be clear, I don't wish policymakers a demise. I appreciate that they have to go to work and do what they do. But we are at a point where the system believes in them in an unhealthy way. And they can't taper without having a terrible temper tantrum.
No, I mean, we just walked through what, the biggest, 2017 and what has happened since then. And, I think to your point, I think that we will all remember, and it's not just me being bitter on Twitter because I wrote half a book about Janet Yellen, but I think we will all remember when Janet Yellen took over at Treasury and when the last time we had a labor economist at Treasury, which was headed into the 70s. So here's
there's so many behavioral parallels to the 1970s beyond, social parallels, cultural parallels. This is a clear social mood echo.
So let's bring the coronavirus into this dynamic, because there is a real economy out there somewhere. And there really are a lot of Americans who are not working. And, speaking of big, small is being eviscerated right now. The small business in America is, the numbers you read, you see some of the survey data that 48% of small businesses aren't sure that they can survive the fourth quarter of 2020. You're like, that has to be a typo. And this is where I get caught up in the inflation debate, because rising interest rates, to me, is, as you say, and by the way, this is a huge light bulb. I'm going to get the transcript of the interview, and then you're going to become a whole week. Then everybody's going to get to read every word you're saying. But to me, rising interest rates, especially as the street views them, is a sign of confidence in the economy. But in the 1970s, we had rising interest rates, and we didn't have such good economic growth at the same time. And yet people tend to talk about inflation or deflation. They never talk about the stag in the middle. So I'm curious where you are on this spectrum, because there is something real going on in the U.S. economy right now. Wall Street wants to get past it. Wall Street has declared that we're in recovery. I doubt that the good people at the National Bureau of Economic Research would agree with them, but Wall Street has declared that we're in the free and the clear, and that we're at the advent of a whole new bull market.
Yeah, scorching. I saw the word last night.
Oh boy.
Yeah, I mean, Wall Street is convinced that post-vaccine, there is, the sky is clear as far as you can see. I think that we've seen a significant low in the commodity space. I look at corporate write-offs like the one Exxon took as a capitulatory act. Those are things that only happen at very lows in confidence. And so I don't know if we've got one more leg down or not, but somewhere around here is a major low in the commodity space more broadly.
Mm-hmm.
And so, to your point, the potential for high inflation, low growth in the United States, I think, is really high. Particularly low earnings growth, because there's a societal swing that's now underway towards wage growth. And so I think that you're going to see more and more states enacting minimum wage hikes. You're going to see a big swing from a pressure standpoint away from the shareholder to labor. The sense that shareholder maximization went way too far.
Mm-hmm.
And so, you're going to have internal pressure on wages that put pressure on the bottom line. Companies will be unable to grow earnings at the rate they expect. And at the same time, it will be socially unacceptable to slash employment in the United States to remedy that situation.
Interesting. So, based on your thesis, companies won't be able, the reaction function won't be what it once was. Because when you read words like culling, you turn on the screen and you see that the stock is way up. And that's kind of still the world we live in. But to see that change, and you could certainly see that shift and you can feel it in the political winds for sure.
Yeah, and I see it, when I started writing about the K-shaped recovery,
mm-hmm.
I never expected it to gain the traction that it did, that it would become, part of the vernacular. And that's significant to me as a researcher because it says people get that. People know exactly what that means, even if they don't. And what that means is the divide between the haves and the have-nots has grown too wide.
Mm-hmm.
And so something is going to press the two back together. I would love to think that those at the top will enable those at the bottom to rise up graciously. But I'm not convinced that that's likely to happen. But I think that the divide has become so simple to explain through the letter K, that it's going to now close.
Yeah, it was interesting because I've had people ask me all the time, why can't we explain to the layperson the influence that the Fed has had on increasing the inequality divide? And because I'm right there with you when it comes to financial literacy. I think it's critical to saving capitalism. There's no hyperbole there. But what's intriguing to me, and I'd love to know your thoughts, is what are the French thinking? I mean, we're burning our own businesses. We're looting our own stores. The French went to go burn down the Banque de France. So, I mean, are they more enlightened? How does the public finally get their head around who the player is in the background?
So, I don't know what the trigger will be. But I think that, I think the Fed is very vulnerable to this kind of social backlash that you're talking about, but perceives itself to be so abstract and so behind the scenes that nobody would come at them.
Mm-hmm. Well, they believe in their benevolence. They truly believe in their benevolence. They believe in the wealth effect. They believe in trickle down. I mean, you've got prima facie evidence staring them in the face, and they still believe.
Yeah.
And that's it's interesting because you're inside of academics, and so you have a bird's eye view in a way to how heavy of an influence academics has been in the field of not economics per se. Because I think of you, I think of William White, I think of Gary Schilling. I mean, it's not economics per se, but boy, has it had an influence on monetary policy making.
Yeah, and corporate policy. I mean, you look at shareholder maximization, coming right out of the 1960s textbook.
Mm-hmm.
So I feel that economic theory is ripe for another massive transition where we throw out the bums. If you were reading, Chicago school economics 50 years ago, somebody, and I don't know who that somebody is, but somebody's going to be the next Keynes who says that was wrong.
And be believed.
What's that?
And be believed.
And be believed. I think a lot of people think that person is Stephanie Kelton. I have a lot of respect for her, but I think that the whole notion of modern monetary theory only exists in an environment where interest rates are at historical lows. If interest rates start to rise, that whole mindset becomes really suspect.
And I think that, to your point, and again, I'm going to go back to Janet Yellen because I think that this is a moment in history. Because if you think about modern monetary theory, you have to reopen the Federal Reserve Act. You cannot have one without the other. You have to have the Fed be able to formally buy treasuries at auction in order to truly set up mechanistically helicopter money. And that is, I'm dear friends with LACY Hunt, and he's been right for so long. But you ask him the one thing in the world that could make interest rates rise, and that's if you reopen the Federal Reserve Act and you allow the mechanism to be put in place, and then you get inflation. Then you get inflation. And to Kelton's point, you're not going to have a Congress say, okay, well, we've got inflation, so we're just going to come together quickly and pass legislation quickly that says we're going to raise income tax rates. It just won't fly.
No, and the higher interest rates go, the more fiscal stimulus comes off the table.
Oh, and I mean, you can't even apply the notion of higher interest rates to how levered our economy is. the divide is too wide. You can't have a conversation about commercial real estate and rising interest rates. Something would blow up in between. It doesn't work. It doesn't work when you think about the $2 trillion that corporations have added since March. Let's shift gears for a minute, because I'm so intrigued in America right now about the coronavirus, and not so much the political aspect of it, how masks have been politicized, not so much that, but why people approach it so differently. And because from my perch in Texas, you would never know that there are record deaths and record hospitalizations, and people are just going about their business. But I'm curious about the idea of fatigue having set in, and what you think has happened in the mindset since the advent of this crisis.
So if I look at the drop in March, you had a profound collapse in confidence, evidenced by Google searches for the word unprecedented. And so the sense that nothing makes sense today, immense uncertainty, and an immense sense of powerlessness. And we don't think of the opposite of confident as vulnerable, but it is. There's an element of control. Confidence is certainty and control together. And when we don't have confidence, we don't have certainty, and we don't have control. And so there was this incredible vulnerability that existed. And you saw people decide at that point, almost this wild, wild west mindset of, how do I regain certainty? How do I regain control? And you saw two models. One was a model that said, we will regain certainty and control if we reopen the economy. And so what you've seen is some portion of the population that went hell-bent on reopening the economy, be damned. Don't need masks. We're just going to plow through this.
I live there.
Yeah. Another segment of the economy said, I will regain certainty and control by hibernating, by going into quarantine, and just block up the walls, close everybody out. I will be safe in my own space with very few people. And if I have to go out into that world, I'm going to wear masks and shields and gloves and spray. And so both of those to me are very clear and deliberate attempts on our part to regain a sense of certainty and control. Mm-hmm. They run in conflict to each other, but that's the nature of what happens in lows in confidence. There are, I actually say there are 5 different responses. Fight and flight get 2, the ones that come to mind, but you also have freeze, you have follow, and you have feed. We will gorge ourselves in those moments. It's why we reach for the Ben and Jerry's ice cream. And to me, it's also not been a surprise that you've seen some Americans fight. The Black Lives Matter. You have lots of social dynamics going on. You have some who are frozen in space in their quarantine. You have others who are following leaders. It's not a surprise, again, in those moments of low confidence that you would see an authoritarian leader like Donald Trump gaining intense popularity amid the environment. And so you have all of these people baking bread. That's the feed aspect of it. But I think that from my perspective, we're seeing a pretty clear response that doesn't seem abnormal. In conflict with each other? Absolutely. But that's the nature of these chaotic moments, is people lose confidence in the institutions and the norms that held us together, and we become pioneers in the wilderness. And what do? Well, some go out, some stay in, everybody plays it their way. And that's my take on what's happened this year.
Is there anything that can shift the mindset back if the virus gets bad enough, or have we decided the path and we're going to take it?
People have decided their path and are going to take it. So there will be a large population for whom the vaccine is a no-go.
Well, we did hear it be called the Trump vaccine, which I found to be 2020's most ironic moment, because that is what would get people who would typically not want to take the vaccine to take the vaccine. I mean, that's the world we live in, as you describe it, the need to follow. And I think that in many ways, that is where we are, also because of this lack of financial literacy. So I think there's a large swath of the population that needs to be led. But again, I feel the same shifts that you do. Talk to me about social media. And I mean, I think a lot of us have seen the social dilemma, and I'm not really talking about the Big Brother aspect of it, but how has, in your view, how has social media changed not the way kids interact, but the way adults behave?
So I look at social media as a symptom of low confidence, inherent low confidence. When confidence is low, our decision making is all about me here now. We don't plan, we don't look into the future, we don't have a great deal of regard for others. It's about me, not you. And so I look at social media as really the perfect vehicle for a bunch of me here now thinking people to act and communicate in me here now mode. And we have a whole infrastructure for this. We have the iPhone. We have developed a network. Amazon delivering to you at home, DoorDash delivering to you at home. We have an incredible me here now economy infrastructure designed to satisfy your every need. You, Danielle, just you can get whatever you want right now. Go to Spotify, go to Netflix, go to, we don't even have to share a pot of coffee. Just bring your pots. So that we have so satisfied the individual that people see no need today to be part of a collective. There's no need to love your brother, love your neighbor, be part of a community.
Yeah, I saw your pinned tweet, and with reference to the K-shaped recovery. I mean, this is the time to be charitable. But to your point, people need to be reminded, and I think that's a change.
And one of the terrible tragedies to me of this quarantining environment is that those who are just have been upended by this pandemic are truly unseen today. People are not getting out into the community and are seeing the reality around them. Mm-hmm. They don't have to. Everything is delivered.
True. It's amazing to me that, and I'm the most fiscally conservative person in the world, but I'm amazed at our politicians debating whether or not there should be an extension of the rental eviction moratorium. I'm like, who are these godlike entities who are talking about putting single mothers out of their homes in January? How could we even be a society that contemplates such an atrocity?
Because we've elected billionaires. We've elected into positions of public policy the very wealthy. And even they don't seem satisfied with that. I mean, you look at the volume of insider trading that goes on in Washington today.
Oh, gosh.
But I think that because this rebound has so benefited them, they have none of the sense of urgency that existed in March. It's not about them. And they have partisanized, I'm not sure that's a word, but so Democrats view the poor as the rural poor. That, why would we help them?
Yep.
Republicans view the poor as the urban poor. Why would we help them? And the reality is, poor is poor. It's a nonpartisan experience.
Right. It is. Sorry, go ahead.
I'm just afraid that those at the top don't appreciate that the most distressing divide is not left-right today, it's up-down. If the rural poor and the urban poor were to come together in America, there'd be a revolution.
Oh, I can't, it goes back to financial literacy. It really does. When we started depriving the average American child of a decent education, that was a moment. And there was a time that the Democrats were a party for the people. And there was a time that there were two definitive parties in America, but it doesn't feel like that anymore.
Now, the environment is ripe for a third party leader to come to the fore.
Mm-hmm.
A young, charismatic individual who can coalesce the left and the right along economic grounds as opposed to ideological grounds.
Well, if you throw rising interest rates into the mix, you'll get exactly what you're talking about. Exactly what you're talking about. So if you had to look forward a few years, given where you started, do you think that there is, and this has always been something I have hoped for to see in my lifetime, but do you think that what we're going to go through economically, because I don't think we have yet, because there's still this confidence in the Federal Reserve, but do you think that there's a chance that Americans, the consumer, ever goes back to being not me here now, not instant gratification, not living on credit, not getting everything that they want if they have access to that credit? And I'm not talking about the poor, and I'm not talking about the rich. I'm talking about the aspirational, the in the middle, the people who watch shows about buying homes and fixing them up and living that life. But do you think that, because I've the people who are frozen, to use your term, the people who went into hibernation, a lot of them have shifted how they consume. And that's going to be permanent. So the coronavirus has kind of been like a Great Depression moment, but it's only for a small slice of Americans. But do you envision, because if you're talking about a 40-year shift in the interest rate regime that we've known for our entire careers, do you think that would change the American consumer mindset?
Yes, I do. I think that you are likely to see an environment where there is savings before spending. And that is going to be a function of both the supply and demand of consumer credit. That culturally more equity will be required. Mm-hmm. And it will be a societal trend that prudence is a virtue. Now, if you think about it, that's an enormous supply and demand suck between now and then. Because you're telling us we can't pull forward demand. We're going to have to push it back while people save up.
But the pulling forward has always been a function of the falling interest rate.
Exactly. So as interest rates rise and the cost of goods goes up in the minds of the consumer and the lender, you'll start to see a demand for more capital at corporate levels, at individual levels. And so that the unwind in this is incredibly painful because it hits, we're going to turn, a screw that's going around really quickly this direction, stop it and turn it back the other way.
I mean, you're talking about a world that is genuinely foreign to most Americans alive today. Hard to fathom.
And it will transform what Main Street looks like, what the suburbs look like. The amount of shopping real estate that will have to be repurposed in the midst of this. Not just because of Amazon and the home delivery aspect, but just a change in buying behavior more fundamentally. This is a generation that doesn't want the stuff that our generation wanted. They look at they look at stuff as a burden, where to our generation it was evidence of success.
Mm-hmm. Interesting. I mean, I can't imagine that world, and I've been writing about getting to that world for a very long time, but I would like to think that the silver lining, maybe we can end on a high note, would be education.
I think it's education. I also think it's a sense of togetherness that is reborn out of this. One of the things that I know from studying confidence is that we will come together first as grassroots communities. And from that, you will see an extension of greater and greater cohesiveness. And again, I don't know who these new community leaders will be, but I'm really excited for them because they will have nothing to lose and they will be coalescing around common purpose, around a need to be heard, a need to be seen. And that's, that next wave is going to be incredibly powerful in whatever direction it goes.
Well, I can tell you just from observation from some of the interns that I've had, and you're in the teaching world, so you've seen Generation Z, and they're nothing like millennials. They're extremely hardworking, and they are more frugal in the way they approach the world, and we could see something really magnificent come from this. So I think that's probably a good place to leave it, Peter, because that's a high note, and I'm halfway to 100, but I'm hoping that I'm not too old that I can't in some way help participate in it. You do a great service for everybody on Twitter. I recommend everybody should follow you just because I try and deliver an education. A lot of times there's volatility and anger in it, but no partisanship on my feed. And you do the same thing. You do a great service as well. And I really appreciate your time today. And I look forward to talking to you next year.
Likewise, Danielle. It's been a lot of fun. Thank you so much for asking me to come on.
Absolutely. Take good care. Happy holidays.
Thank you. You too.